What happens when two longtime rivals move from conflict toward possible talks? The answer isn't just in the headlines, it's in your wallet. Welcome back to Yearn to Grow. This channel is about understanding finance and insurance clearly and calmly. No pressure, no shortcuts, just clarity. Today, we are diving deep into a geopolitical shift that could redefine global markets in the coming months. It is a story of power, energy, and your money. Fresh reports suggest new talks between the United States and Iran could resume soon, after earlier meetings ended without a final agreement. This potential breakthrough comes at a time when the world feels more divided than ever, yet more economically intertwined. And this matters far beyond politics, because when tensions rise between major powers, the effects can spread into everything we touch. We are talking about oil prices, gold, inflation, stock markets, and the everyday cost of living for you and your family. So the real question is simple. What happens next? And how could it affect you? To understand this, we need to look at the problem of market uncertainty. The problem isn't new. It traces back to the 1953 coup that reshaped Iran's destiny and its relationship with the West forever. Then came the 1979 revolution, ending decades of alliance and turning a key partner into a primary adversary overnight. We saw a brief moment of hope with the 2015 nuclear deal, but that clarity vanished with the 2018 withdrawal, leaving markets in a tailspin. By early 2026, tensions reached a critical zenith. Military operations led to a direct missile exchange and a blockade of the world's most vital waterway. The recent tensions created serious concern across global markets, especially because of one key location, the Strait of Hormuz. This is a narrow neck of water, just 21 miles wide at its tightest point. It is the only exit for the Persian Gulf's massive energy exports. This is one of the world's most important energy routes, where nearly one-fifth of global oil shipments move through every single day. It's not just oil. Nearly 20% of the world's liquefied natural gas, dominated by Qatar and the UAE, must pass through these waters. This brings us to our insight. If anything disrupts this route, even for a few days, global markets react quickly and often violently. Beyond energy, the strait carries 30% of global urea and 20% of ammonia exports. This means a blockade affects the very food on your table. That's why investors, governments, and businesses are watching these talks so closely. It is the pulse of the global economy. Earlier discussions reportedly ended without a full deal. Major disagreements remained around security demands and Iran's nuclear program. But now, new reports say another round of talks could happen soon, with mediators trying to keep diplomacy alive and avoid a bigger escalation. Now let's move into our explanation. What can happen from here? There are two primary paths the world could take. The first possibility is a positive outcome. If talks go well, markets may feel an immediate and profound sense of relief. Oil prices could stabilize or fall if supply fears reduce. In March 2026, we saw Brent crude surge past $120. A deal could bring it back to earth. That matters because oil is the lifeblood of our modern world. It is the hidden cost in almost everything you use. It influences transport, manufacturing, shipping, and fuel costs around the world. Every product you buy has a transport cost built in. If oil stays lower, inflation pressure can ease. That can help consumers and businesses breathe a little easier and plan for the future. Gold, which often rises during uncertainty, could cool down. In 2026, it reached record highs over $5,000 per ounce as investors fled to safety. Stock markets may also respond positively because markets prefer stability over conflict. Clarity allows for the long-term investment that drives growth. And for regular people, that could mean less pressure on fuel, travel, and daily expenses. It translates to a more predictable household budget. But there is also a second possibility. If talks fail or tensions rise again, markets may move in the opposite direction with terrifying speed. Oil prices could jump sharply if traders fear a total supply disruption in the Middle East. Speculation alone would drive prices up in hours. Gold may rise further as investors scramble for safe assets, fearing a broader conflict. We've seen it hit $5,600 in times of crisis. Stocks could become volatile or crash as uncertainty increases. Sectors like airlines would be hit hardest by skyrocketing fuel costs, and inflation concerns would return, especially in countries already struggling. This creates a cycle of economic pressure that is hard to break. This brings us to the realization. Even if someone lives far away from this conflict, the impact can still reach their wallet. Global events are local realities. They connect directly to prices, jobs, investments, and future planning. We are no longer isolated from what happens across the ocean. For India, oil prices are especially critical. India imports nearly 90% of its crude, and half of that comes from the Middle East. India's strategic reserves hold only 9.5 days of net imports. A prolonged closure of the strait would be a structural shock to the entire economy. So, what should your takeaway be? What should people watch next? It's about being prepared instead of being surprised by the headlines. Watch for confirmation of official meetings. Diplomats often signal their intent through small, carefully worded statements. Watch how oil prices react. Markets are the most honest reflection of global sentiment. If oil cools, the world is breathing easier. Watch market confidence. Most importantly, watch whether both sides choose negotiation over escalation. Negotiation brings clarity. The bigger lesson here is simple. In today's world, global politics and personal finance are deeply connected. Understanding these moments is a survival skill. History shows us that even the deepest rivalries can find a path to talk. It requires patience, strategy, and the courage to seek stability over chaos. In your own finances, seek that same stability. Be the diplomat of your own budget. Stay informed, stay calm, and plan for the long term. To truly understand the weight of these talks, we must go back to the nationalization of Iran's oil in the 1950s, a moment that sparked the first major rift. Ironically, it was the US that provided Iran with its first nuclear technology under the 1957 Atoms for Peace program, seeding the very issue we debate today. During the Cold War, Iran was the island of stability for the West, a key ally in a volatile region, securing the energy flow of the 20th century. When the Shah fell in 1979, the global energy architecture was shattered. Oil prices doubled almost instantly as production collapsed. The ensuing 444-day hostage crisis didn't just end diplomacy. It introduced a risk premium to Middle Eastern oil that has never truly vanished. Let's look deeper at the strait itself. It's not just water. It's a strategic choke point that can hold the world's economy hostage. At its narrowest, the shipping lane is only 2 miles wide in each direction. Imagine the world's energy supply trying to squeeze through that needle. During the tanker war of the 1980s, over 500 ships were attacked in these waters. The fear of history repeating itself is what drives markets today. If the strait is closed, nearly all of Qatar's LNG exports are stranded. In a world moving toward natural gas, this is an existential threat to energy security. The International Energy Agency has warned that a closure would be the largest supply disruption in history, far surpassing the 1970s energy crisis. We mentioned fertilizers. Iran is a major producer of urea. A disruption here doesn't just raise gas prices. It raises the cost of farming globally. Higher fertilizer costs mean more expensive grain, which means more expensive meat and bread. The ripple effect is total. Global markets are currently hypersensitive. A single rumor of a missile test can move the S&P 500 by percentage points in minutes. This flight to safety is a predictable human reaction. When the world feels unstable, we move our money into what has held value for millennia. In March 2026, we saw gold reach a staggering $5,614 per ounce. This isn't just a number, it's a measure of global fear. Look at the divergence. Airline stocks plummeted while mining companies surged. In finance, one man's crisis is another's opportunity. The oil inflation trap is real. High energy costs act like a tax on the entire global economy, shrinking the purchasing power of every citizen. This puts central banks in a corner. They must keep interest rates high to fight inflation, which slows down growth and makes loans more expensive. India has been trying to diversify, buying more from Russia and Guyana, but the Middle East remains its structural foundation. 90% of India's LPG, the gas used for cooking in millions of homes, transits through the strait. This is a direct link to the Indian kitchen. Every $10 increase in oil prices expands India's trade deficit and puts immediate crushing pressure on the rupee. While India has strategic petroleum reserves, they only cover about 9.5 days of net imports. It's a buffer, but not a permanent shield. The realization we must face is that we live in a global village. A decision made in a boardroom in Geneva affects the price of a bus ticket in Bangalore. Our just-in-time supply chains have become just-in-case energy security models. We are trading efficiency for survival. When energy prices spike, small businesses are the first to feel it. Their margins disappear, and with them, the dreams of local entrepreneurs. As we look forward, the takeaway is vigilance. Watch for the confirmation of meetings. In diplomacy, the venue is as important as the menu. Trust the markets more than the headlines. If oil prices stabilize, it means the smart money believes a deal is possible. The ultimate sign of success is when both sides choose negotiation over escalation. It's the only path that leads to long-term market sanity. Building a bridge between rivals is a slow, agonizing process, but it is the only way to cross the chasm of economic despair. The motivational lesson here is that conflict is expensive, but peace is an investment. It requires the courage to sit at a table with your enemy. Apply this to your life. Seek financial peace by staying informed. Don't let the noise of the world dictate your inner calm or your outer strategy. So tell me, in a world of chaos, are you betting on a diplomatic breakthrough or a continued storm? Let's discuss in the comments below. The roots of this rivalry go even deeper than the 1979 revolution. In 1953, the overthrow of Prime Minister Mossadegh left a scar that still bleeds in Iranian memory. Operation Ajax wasn't just a coup, it was the moment the US chose energy security over a fledgling democracy, a choice that still haunts the region. For 25 years, Iran was the West's primary military and economic partner. This era of great civilization was built on a foundation of oil and alliance. The 1979 revolution wasn't just political. It was a total cultural and economic pivot away from the West, catching the world's energy markets completely off guard. The second oil shock proved how dependent the world had become on a single region. Prices tripled, causing a global recession that lasted for years. The 8-year war with Iraq further destabilized the Gulf, forcing global powers to send navies to protect the flow of oil through the Strait of Hormuz. Look at the bathymetry of the strait. It's not just narrow, it's shallow. Most of the deep-water shipping channels are only a few miles wide. During the tanker war, both sides used sea mines. A single mine can shut down the entire strait, as modern tankers are too valuable to risk. The Musandam Peninsula, belonging to Oman, overlooks the entire passage. This is the most watched piece of real estate in the world. As we move to gas, the strait's importance only grows. LNG cannot be easily stored or rerouted like oil. It is a fragile lifeline. The UAE has built pipelines to bypass the strait, but their capacity is only a fraction of the total flow. There is no true replacement for Hormuz. We can't overstate the fertilizer link. 30% of global urea comes from here. Without it, global crop yields would collapse within a single season. This is how a conflict in the Gulf turns into a food crisis in Africa or South America. The connection is direct and devastating. In market psychology, fear is a more powerful motivator than greed. It drives investors to dump stocks and buy gold in a blind panic. The US dollar and gold are the twin towers of safety. When one rises, it often signals that the world is bracing for a storm. Gold at $5,614 per ounce in March 2026 was the highest inflation-adjusted price in history. It was a clear signal of market desperation. Despite the pressure, emerging markets like India are showing incredible resilience, finding new ways to secure energy and maintain growth. The oil inflation trap is real. High energy costs act like a tax on the entire global economy, shrinking the purchasing power of every citizen. Central banks must choose between fighting inflation and supporting growth. In a geopolitical crisis, there are no good choices, only less bad ones. India's energy security is a constant balancing act. The nation is building more reserves, but it's a race against time and price volatility. Watch the confirmation of meetings closely. Are they meeting at a neutral site? Are they sending their top negotiators? These are the real signals. The future of Indian manufacturing depends on stable energy. It's the engine that will drive the next decade of development. Emerging markets are not just victims of global shocks. They are the new leaders in finding creative solutions to energy and financial crises. This is why we say global politics are personal. The headlines in the morning determine the prices you pay by the afternoon. We are entering an era where energy security is more important than energy price. Nations are stockpiling resources like never before. The strategy for the small business is simple. build resilience. Use technology to lower your energy footprint and protect your margins. Watch the confirmation of meetings closely. Are they meeting at a neutral site? Are they sending their top negotiators? These are the real signals. Watch the venues. Watch the body language. In high stakes diplomacy, the silence is often louder than the speeches. Dialogue is the only antidote to volatility. Even a failed round of talks is better than no talks at all, as it keeps the channel open. Building the bridge to stability is a feat of human engineering and political will. It is the most important bridge we will ever build. The motivational lesson is that you cannot control the world, but you can control your reaction to it. Strategy is the tool of the resilient. An informed citizen is a powerful one. By understanding these global shifts, you are better equipped to protect your family and your future. So, do you feel more prepared now? What other global topics should we break down for your financial health? Tell me in the comments. If this explanation helped you see things a little more clearly, that is exactly what this channel is meant for. We will continue breaking down finance and insurance concepts step by step in a way that feels practical and manageable. If you find this helpful, please like the video, subscribe to the channel, turn on notifications so you do not miss future videos.